Hello and welcome to the DIY Investing YouTube channel. We're working through every company in the S&P 500, and today is Essex Property Trust, ticker ESS. Over the next few minutes, I'll discuss my thoughts on both the valuation of this company and its business quality. First up, this company has a market cap of $13.8 billion, enterprise value of $16.6 billion. So you see about $6 billion in net debt on this business. That's actually quite significant because it's about a third of the overall enterprise value. The debt is about half the market cap. That's a very large amount of debt for any business, even for a real estate investment company. So this is a real estate investment trust. REIT is what they're commonly known, and the business description should tell us a little bit more. So they're a fully integrated real estate investment trust, acquire, develop, redevelop, and manage multi-family residential properties. That's the key term here, and West Coast markets. So it's probably apartments, yes, 246 apartment communities, 60,000 apartment homes, and 6 additional properties in development. So we can learn a little bit from that. They're both developing additional properties, not just, staying stagnant. They have about 60,000. They're on the West Coast. Now, West Coast markets tend to be relatively expensive areas. You'd expect relatively low returns on invested capital, which is what we see here. You see here this top line on return on invested capital chart. We're at 5%. They never exceed 5%. Now, that is immediately a red flag for me as a potential investor. I want my return on invested capital numbers to be 10% or above if I want to get a 10% return as a shareholder. Now, return on invested capital isn't what matters. Return on equity is. And so you can leverage the return on invested capital to be higher than to get your return on equity up. You can use that debt. They are doing that. But the fact that this number isn't even above 5% is concerning because it makes it really unlikely we're ever going to see a 10% number. Now, what's positive here is that they have 20 straight years of profitability. Anytime that you never lose money is a good sign. The ability to not lose money means that even during bad parts of the cycle, you're going to do okay. And you see 2008 to 2011 here was a pretty bad part of the real estate market. Although the return on invested capital dropped down to the 1% range, they didn't lose money, and that is good to see. The downside here is you can clearly see cyclicality. They're flowing with the housing markets. They don't have any sort of resistance to it. Their business model doesn't have that resistance. So it is cyclical. It makes it hard to predict the future. If anything, you're at the high parts of the cycle here. That would make me hesitant to extrapolate high earnings because if these numbers trend back down towards 1%, you're talking about a 50 to 60% drop in your earnings capability, and that could be a very big concern for you as a shareholder. So here I'm going to call this so far an average company, maybe slightly above average because they don't lose money over the course of a decade, but I'd still call it average because that's cyclicality. Now, 10-year median returns back this up even further, 3.3% average return on invested capital. That debt that I talked about before is turning that 3.3% into a 6.8% return on equity. This is a big problem for me too, because if you think about this, this is going to cap your returns as a shareholder. 6.8% is going to be what your upper end expectation is for a shareholder if you're holding this over the long term. You're not likely to earn more than your return on equity. Now, what's interesting here is, well, then why is this company trading at such a high PE ratio, 38.6? So we need to evaluate the earnings to see if these are real earnings, if there's something going on that's weird with them. So you see $7.51. That is a drop down from 2020 at $8, but it's not abnormally low compared to the last decade. It's actually the second highest year on record. You had 6.6, 5.9, 6.5, 6.2. So 7.5 is not abnormal. And so when you think about this $212 per share, that's a really high valuation they're placing on this. You can also see that the dividend payout ratio is astronomical. You're paying more dividends than earnings each and every year. $4.40, $3.40. $4.84, almost 20% higher than your earnings, maybe 10 to 20% higher in an average year. That's insane when you think about how fast they're growing. Where's this money coming from? They're certainly not running it through internal cash generation. So how are you growing at 12% a year in revenue and assets, 20% a year in EPS, 34% free cash flow, with these sorts of returns on assets? And the answer is two things: debt and share issuance. So we're going to see that in the income statement and the balance sheet as we dig a little bit further. If you're enjoying this video so far, hit that like button. Don't forget to subscribe. Hitting that like button and your subscriptions are a great way to support the show. I really appreciate it. So that is the number one way I would like you to help me out. Now let's go to the income statement. You can see, of course, they have really nice margins on their revenue, not abnormal for a real estate investment company. They've basically doubled their SG&A, but they've tripled their gross profit. So that's actually a good sign because they've kind of held that in check a little bit, which has allowed them to, again, triple their operating profit. That looks good as well. Pre-tax income has tripled, almost 4x'd. You basically 4x your net income. That's a good sign over the course of a decade. But I mean, if you think about what's going on here, you've gone from 125 million in net income to 500 million in net income. That's a 4x over the course of a decade. That's about a 15% annualized growth in net income. However, you've doubled your share count from 35 million to 66 million, which means that instead of getting a 4x over the decade on a per share basis, you're really only getting a double on the per share basis. So this dilution is astronomically bad for your returns as a shareholder. So instead of getting like a 15% annualized return, you're getting more of that 7% annualized return. Where does that 7% match up to what we said before? Here's your 6.8% return on equity, and that's where those numbers are tying in together. Now let's go to the balance sheet, and we should see a rise in debt. And we do. So you see long-term debt, 2.2 billion is growing to about 6 billion in debt over the course of a decade. You've tripled your debt. Now, what's good about tripling your debt is you 4x'd your net income. Tripling your debt is a little less than that. So you do like to see how that played out. You have basically tripled your assets. It's not that those are growing in line with each other. And you can see these retained earnings being negative. This is what's going on here with these very, very high dividend payouts is you're not allowing any retained earnings to build up. It's being completely, funded by this new equity and debt that's being issued. Cash flow statement. So what are they doing here? What you can see is that these cash paid for dividends, of course, is exceeding your net income, but they tend to be lower than your cash flow from operations. And what they're doing is basically funneling the difference in the fact that you get a lot of free cash flow, and they're kind of giving shareholders back some of this depreciation and amortization. Now, if they were doing that without issuing shares here, without having stock-based compensation, then that would be one thing. That would be actually really attractive. It would show you the benefit of being a real estate investor is that you're able to pull off the depreciation of their assets, and it actually is cash flowing higher than the net income, and that's what's happening. The problem is they're certainly reinvesting this in PP&E. They're reinvesting in acquisitions here. And they're taking on debt and they're diluting you in order to do this. And that's where I start to have a concern. If you just didn't have the net issuance of stock, if you didn't have the net issuance of debt, and yet you still paid a bigger dividend than your net income, okay, that's fine. That's how the real estate company can work. The reason they're having to do this, though, is these low returns on invested capital, which is why from the very beginning you can see that as a red flag. You see this number is just too low to justify a long-term equity holding as a shareholder, and for that reason I'm going to pass on Essex Property Trust. I consider the valuation just ridiculously high. Why is it this high? It's simply because the CAGRs are so fast. People like fast growth. They don't really care if they're getting diluted. They don't really care what's going on and why it's happening. They just like fast growth. To me, I see fast growth here combined with this low return on invested capital. I see a red flag, and I'm going to avoid the stock. If you enjoyed this video, please smash that like button. Don't forget to subscribe, ring the bell, and I would really appreciate you doing that. Now, if you enjoy the software that I'm using, it is quickfs.net. The first link in the description below is my affiliate link. You can sign up for a free or paid account. I really recommend trying it for the free account to learn how to use this software. You can do just like I did and analyze the company in 5 to 10 minutes. It's very good software. I use it myself all the time, and I think you would really gain from that as well. Here at the playlist, I really recommend the best 30 plus S&P 500 companies that I've already reviewed. These are my watch list companies. Although I didn't like Essex Property Trust, there are some that I really, really like. So check out that playlist at the top of the video. Thank you for listening. And until next time, stop paying fees, start building wealth.